If you ask most traders whether their strategy is good, they'll usually give you one number, their return, maybe their win rate, or maybe they'll show you an equity curve that looks almost too good to be true. And for a long time, I thought the same thing. I believed that if a strategy made money in a backtest, it was probably worth trading. But after building strategies, running thousands of backtests, and analyzing thousands of data points, I realized something. The return is often the least interesting part, because two strategies can make exactly the same amount of money, while one is far more likely to survive in live markets than the other. And that's because profitability alone doesn't tell you whether you actually have an edge. It doesn't tell you how much risk you took, doesn't tell you how consistent the strategy is, and it definitely doesn't tell you whether those results happened because of skill or because the market simply moved in your favor. That's why professional traders don't stop at the equity curve. They look at a completely different set of statistics. And in this video, I will show you the 3 most important metrics and when you should use each of them. Because once you understand what these numbers actually mean, you'll never look at your backtest results the same way again. And one of the metrics might even reveal opportunities to improve your strategy that most traders completely overlook. So let's move to the first one, expectancy. In my opinion, it's one of the most important metrics every trader should understand. Because here's what most people get wrong. They assume a high win rate automatically means a profitable strategy, but that's simply not true. Imagine one strategy wins 90% of its trades, but every losing trade wipes out 10 winners. On paper, the win rate looks incredible. In reality, the strategy slowly loses money. Now imagine another strategy that only wins 40% of the time. Most traders would ignore it immediately. But if the average winner is 3 times larger than the average loser, that strategy can be consistently profitable for years. And that's exactly what expectancy measures. It tells you how much you can expect to make or lose on average every time you take a trade. The formula is actually quite simple. Expectancy equals your win rate multiplied by your average win minus your loss rate multiplied by your average loss. A positive expectancy means that over a large enough sample of trades, the odds are statistically in your favor. A negative expectancy means that no matter how good the equity curve may look over a short period, the strategy is unlikely to hold up over time. This is why professional traders care far more about expectancy than they do about win rate alone, because expectancy tells you whether your edge actually exists. But there is one more important thing you can learn from this metric, and that is where your edge is actually coming from. Because a strategy can have a positive expectancy overall, while the performance between long and short trades tells a completely different story. For example, imagine your strategy has a strong positive expectancy, but almost all of its profits come from long trades. That might look impressive at first, but you have to ask yourself why. Was your strategy actually finding profitable opportunities, or was it simply benefiting from a strong bull market during your testing period? This is why comparing long and short performance is so important. If your long trades significantly outperform your shorts, it doesn't automatically mean you should remove short trades. The market environment might be the real reason behind the results. A strategy tested during years in a bull market can make almost any long system look better than it really is. But if your short trades remain profitable even when the market is trending upward, or if your long trades continue performing during difficult market conditions, it's far more interesting. Because it suggests your results are less dependent on market direction and more likely to come from a genuine statistical edge. The goal isn't just to find profitable trades. The goal is to understand why those trades are profitable. And once you understand where your edge comes from, you can make much better decisions about whether it is likely to survive in the future. But even if a strategy has a strong expectancy and the performance between long and short trades looks convincing, there's still another important question you have to answer. How efficiently is that strategy generating returns compared to the risk you are taking? And that's where the Sortino ratio becomes extremely useful. Most traders only focus on returns. If one strategy makes 50% a year and another makes 30%, the first one immediately looks better. But those numbers don't tell the whole story. What if the first strategy regularly experiences massive drawdowns, or if the second strategy reaches its returns much more consistently while exposing your capital to far less downside risk? That's exactly what the Sortino ratio is designed to measure. Instead of treating every fluctuation as risk, it only focuses on harmful volatility. In other words, it asks one simple question. How much return are you generating for every unit of downside risk you take? The formula is Sortino ratio equals the return of the strategy minus the risk-free rate divided by the downside deviation. The higher the number, the more efficiently your strategy converts downside risk into returns. And that's incredibly important because two strategies can generate almost identical profits while having completely different risk profiles. One might feel almost impossible to trade because of deep drawdowns and long recovery periods. The other might produce a much smoother equity curve with significantly less downside. A profitable backtest doesn't automatically mean you have a profitable strategy. The traders who consistently build robust systems aren't the ones chasing the highest returns. They're looking for robust and proven strategies.